Hi, I'm Doug Draper with Acme Distribution and the Denver Transportation Club. I'm pleased to present our series, Supply Chain and Logistics, the Storytellers. The series is brought to you by Cap Logistics, and Cap Logistics are experts. They're offering you customized transportation solutions for all of your needs. So please visit Cap Logistics today. All right, I think we got a great show. I'm excited about it today, and I'd like to welcome Richard Waryn, who is the president of LDK Logistics here in town. So welcome.
Thanks, Doug. I'm happy to be here.
Yeah. So the topic today is pretty interesting. We're going to talk about venture capitalists or venture capital money and private equity and kind of how that's evolving into the logistics space and things of that nature. So before we jump into our topic, I know the audience likes to learn a little bit about our guest. So tell us about yourself, your background, and kind of how you got into the industry.
Sure. Yeah, so I spent about 2 decades in private equity. I was involved in basically organizing and investing kind of large funds, largely in emerging markets. So I did a lot of work in Europe, in Russia, in Middle East, and Asia, and through a whole variety of funds, including buyout funds and large infrastructure funds. So that was really my most of my background. I lived in London, Moscow, and Dubai. Moved to Colorado actually from Dubai when I was wrapping up my last fund, and my wife was sort of decided she didn't want to be a lawyer anymore. We picked Colorado as a great place to raise our family, and been happy here ever since. And then that's actually how I got into the logistics business. Was when we moved here. I spent a couple of years looking at different companies to acquire, and I wanted to do it privately. I wasn't going to do it as a private equity fund. And I came across LDK. LDK has been around for 20 years. It focuses white glove and first and final mile deliveries, covering vertical sectors in the tech space, medical, retail, and we also do some in-home deliveries as well. Okay. So it was a great company. As a private equity investor, I mean, my real skill set was as a generalist in different sectors, but really understanding how companies, operate and how to basically build value in those companies. And that was my introduction into logistics, and I have never looked back. I've loved the sector. I've learned a lot more about it, obviously, since I've acquired LDK. And it's been a really interesting adventure, and I felt it was kind of accidental, but I ended up buying this company really at the right time. And as we'll be discussing kind of, I think, later in this program, a lot of investors from, individual investors through VCs and private equity are now really looking at the sector hotly because there's just a lot going on in it for a variety of reasons.
Yeah, for sure. Well, the logistics business, it's like the mafia. Once you're in, you're never getting out.
That's what everybody says to me.
You're stuck.
Absolutely. I'm happy with that.
Yeah, cool. So I know there's a lot of acronyms around financing and investment. So let's just start simple and talk about what a VC is and for private equity and how they're different and how some of that money's structured.
Yeah, so there's a spectrum of investors, just like there's a spectrum of types of companies in terms of stage of evolution of companies. So everything from when you first have an idea, back of the envelope, to fully mature multi-billion-dollar companies that list on the New York Stock Exchange. So, and there are investors that kind of invest in different stages of a company's life cycle. So when you're at the very, very beginning stages, even before VCs come in, I mean, there's, things called friends and family, which kind of finance you when you've just got a brand new idea, but nothing beyond that. And then once you kind of get an idea that's kind of got some legs to it, you then approach angel networks, which basically are kind of a step up from the friends and family. And the companies that survive that cycle then typically will look at venture capital money or VC money. And VC money looks at very early stage companies banking on high growth. And that's really the focus there. And typically, you need a minimum valuation of about $6 million to kind of get VC interest at this point. And those numbers have been getting larger because there's been more and more money going into venture capital. But they typically, you don't necessarily need, in some cases, you don't even need to be profitable, and in many cases, you're not profitable yet. So they're investing at that very early growth stage where they're thinking that at some point there's going to be a hockey stick, and you invest, you build the market share, et cetera, and then eventually it kind of takes off. The next stage beyond that is private equity. And private equity typically will look at more established companies that have clear cash flow or EBITDA, which is earnings before interest and tax and depreciation. Those cash flow numbers are very critical. And so, Colorado is a great example. I mean, there are many companies here that have been, family-owned businesses that have been around for, in some cases, decades that, built nice businesses and in many cases never even taken in private equity money. Mm-hmm. Those are exactly the kind of targets that PE is looking at right now. Because, when you look at transportation and logistics as a whole, I mean, it's over $1 trillion of kind of GDP. It's the largest sector that nobody ever really talks about very much. And it's critical. You can't outsource, transportation to China. I mean, you need local companies with local knowledge, with, expertise and equipment, locally that can deliver things. And so what that's led to is, frankly, tens of thousands of companies in the U.S. transportation sector, many of which are, kind of mom and pop companies or, relatively small companies. So it's a very disaggregated sector. A lot of those companies have not really attained, efficiencies in terms of use of technology, for example. And all of that makes the entire sector really ripe for consolidation. So, and that's why, both VCs on the technology and early startup side through to mid-sized private equity and large private equity are really piling in at this point.
Gotcha. So why now on the investment and interest in logistics and supply chain? Like you said, it's been kind of a sleepy industry. There's lots of mom and pops, and that they're hitting retirement age, and they're like, my retirement's in my business. I need to
correct
to get out. So why all of a sudden is logistics of interest?
Well, and frankly, if you're in that position, if you're an owner of a company looking to sell or retire, this is frankly a seller's market at the moment. And the reason for that is private equity evolved over the last couple of decades, and there's both institutional money and a lot of private money that's gone into it. And basically the structure of a private equity or VC fund it's what's known as a closed-end fund. So the funds themselves typically have a lifespan of say, typically about 10 years with some extensions. But so it's not like a mutual fund, which is kind of just perpetually open and can last for, forever. The private equity and VC funds actually have very finite lifetimes. What's happened is that so much capital has gone into these funds, and that they're now all looking for deals. And if you add it all up, there's over $1 trillion of what's called dry powder, which means capital that's been committed to the funds but hasn't yet been invested. The typical window for or investment period for a fund is I typically have to make those commitments within about a 5-year window. So you close a fund, you've got 5 years to kind of find great deals, and then another 5 years to kind of mature those deals and exit out. So these things are very defined time-wise. With $1 trillion dry powder overhang, I mean, there is a lot of money looking for deals, number one.
Right.
Number two, the transportation sector has never been, viewed as very sexy, frankly, right? I mean, when you look at all the different other things that in technology and telecoms and media and all the other stuff that, has gotten a lot of the attention of the funds, transportation kind of doesn't, rank that high on that. However, baseline for those funds that really understand kind of intrinsic value and how to basically put companies together and kind of create, larger agglomerations, this is the perfect opportunity because this sector has been so underlooked. So I think it's a combination of how much money is out there to invest and the fact that this has just been, a relatively sleepy sector.
Mm-hmm. A lot of dry powder and a sleepy industry that is the two come together.
Yes.
Have you noticed, so on the Storytellers, we talk a little bit about the different types of transportation, air, ocean, ground, rail,
sure.
and let's talk about assets. Is there a specific segment of those four that are more of interest with these funds than another one?
So there's actually been a lot of interest in the non-asset-based sector. Okay. So meaning, companies like LDK, frankly, which is a 3PL or 4PL kind of companies, which rely, on the use of technology and vendor networks and have relatively low costs as relates to assets. Because, I mean, assets ultimately, can be great, but they also, can be risky. And, if you're a big trucking company with lots of trucks, you end up, having lots of maintenance issues. You've got lots of truck employee issues, et cetera, et cetera. So, think about it, the largest, cab company in the world is Uber. They own no cabs. The largest hotel company in the world is Airbnb. They own no hotels. Mm-hmm. So that's kind of the sweet spot, is companies like that exist in transportation that, kind of employ technology and are relatively asset light. I mean, that's kind of the highest end of what people are looking at right now, which is not to say that asset-based companies are unattractive, but they typically will command different multiples. So the highest multiples typically will go to these non-asset-based type companies.
Right. So do you see, speaking of the asset-based companies, and there's obviously lots of billion-dollar asset companies out there, FedEx, UPS.
Sure.
Are they getting into the game in the sense they're like, oh my gosh, there's all this, dry powder that's out there that's coming in and taking up these technologies that we need, and we're going to be late to the table.
Yeah.
Are you seeing large asset-based companies getting into it, or are they just not? Talk about that a little bit.
Well, probably the biggest one that's gotten into it is Amazon, of course, because they're trying to create an integrated supply chain throughout their entire ecosystem. And so they've been buying up, small tech companies and larger distribution companies. I mean, they're just a huge player. I mean, because of their, first of all, I mean, they've got, obviously a ton of money, and they've got more money than most, private equity funds or VC funds ever will have. So they're a huge player in that sense. But there's been a lot of consolidation just within the industry itself. I mean, XPO, for example, is a classic. I mean, they've increased their revenue by an order of magnitude by acquiring companies like in their space. Another example is that recently happened. I mean, just in terms of what's happening in the industry in general is, for example, CEVA, right? So CEVA was a company that was founded by Jim Crane, decades ago, originally as Eagle Logistics. It sold to Apollo, which is a large private equity fund. They held it for a few years and just sold it to a strategic. So their exit was actually to a European shipping company. So sometimes there's a confluence in terms of like who owns these companies for periods of time and then who ultimately buys them. But yeah, the strategics are absolutely out there. I mean, they're and it's frankly even, we at LDK, we're looking now at acquiring companies that will be part of our ecosystem as well. And those are just strategic acquisitions for us. Gotcha.
Let's talk about some technologies like transportation management systems that kind of overlay and support the logistics industry. Are you seeing investment in those type of
big
groups?
Time. Yeah, big time. Because
again, any specifics about different?
Well, those are very scalable, types of investments because, especially if you can apply sort of a SaaS model where you can effectively, get a monthly or just kind of a periodic subscription model, because that becomes a very attractive cash flow stream for these companies.
Sure.
But yeah, all of the companies that are now expanding or making these kinds of investments are looking at some kind of a technology platform. Whether it's a kind of a full enterprise solution in the trucking industry. There's been a lot of new regulation in trucking having to do with tracking the trucks and tracking drivers, et cetera, et cetera. And so companies that apply to those technologies are really hot right now as well as kind of warehouse management software and technologies that track specific shipments. And it gets to the point where you can put a little sticker on a package and track it like up to whatever floor it goes to in a building. So those kind of things are really coming on right now.
Interesting. So CEVA was a good example because they were had the money in and then they flipped it. So you and I come in and we invest in this great technology. What do we do then? Are we waiting for a set period of time, 3 years, 5 years? Are we waiting for it to hit a multiple? And then who are we flipping it to? Like, what's the next evolution of that process?
Yeah, so private equity funds, when they're pitching to their investors, they'll pitch a theme. So they'll say, we're going to be investing in these types of companies, or they might pick even sectors within, subsectors. And they'll typically have target rates of return. And that doesn't mean every company that they invest in will obviously achieve that. And on the VC side especially, some companies go to zero, but they bank on investing in enough that like the winners will basically offset the losers and they'll still achieve some, whatever their target rate of return is. So it's a combination of time and rate of return. So as I mentioned, the investment period for private equity is typically about 5 years in terms of the window that they've got to make those commitments, and then another 5 years to mature those investments.
Right.
As they get close to that, the end of the fund lifetime, they start really thinking about, okay, how are we going to monetize these investments? And so if they've achieved their target rates of return during that, say, 10-year period, then they will have exited out. If they're getting close to their time horizon, they may also exit out, and they may take, a less attractive multiple simply because they need to get out of those investments.
Gotcha. Have you seen, so you got the evolution of the timelines you just mentioned. Is the investment still too early that we've seen any large companies exit out of, that they've worked their life cycle of the investment and they're starting to flip? Or are we in a position now where it's like the early adopters, if you will, and people are still pumping money in?
Kind of both. I mean, there have already been some, like we mentioned Siva. I mean, so that was an investment that happened, I think it was 5 or 6 years ago. And it's matured and they've exited out. But there's still, so much potential right now. I mean, in terms of getting in, as an investor. So, I mean, if you're invested in a private equity group that focuses on transportation or a generalist private equity group that just does these kinds of deals, tremendous opportunity. I mean, this is going to be the case for the next, several years, certainly.
Gotcha. So with all this this money and cool technology and things developing, what does that mean to the end consumer, right? So I'm listening to this show right now, and I'm like, that's cool. It sounds great. I like to track my shipment to the 11th floor to my door.
Sure.
But what does that mean for the average consumer or a business owner?
Theoretically, it should mean better efficiencies. So that means better, ability to communicate between the customers and the vendors. It means better ability to track your shipments. It means probably more cost transparency and probably some better pricing. And, again, if we take a look at what's happened in same-day delivery just on the consumer side, and the fact that, Amazon Prime can now get a package to you, within 24 hours. I mean, that's an amazing accomplishment when you think about the logistical challenges of that. So I think that's going to continue. And, we talk about drone deliveries and things like that. So, I think there's going to be a lot of interesting, developments coming down the pike. On the more commercial side, driverless trucks. They already exist in certain parts of the world, and they're going to get more and more common. And part of that relates to the fact that we have a truck driver shortage in this country, and so that may be a solution for that, and that's pretty near.
Yeah. Do you see more investments coming in? So let me see. My question would be: all right, so we put in $500 million into this company and this technology, and it's not quite doing what we're doing. Do you see people putting more money into it because they can see, hey, the vision is just right over the hill, and so we're going to chase some more money and make it happen? Or do you think that this is a defined, or I can't think of the right word, disciplined type of investment where they say, hey, if it doesn't happen on this time, we're just going to eject and get out? Do you think more money will still coming in?
So
it's kind of a long question, so I apologize if it doesn't make sense.
No, so I think it's a mix. I think that when a private equity fund invests in a company, they have a certain objective in terms of where they want to get to and the time frame and kind of what needs to happen. When things don't quite happen the way they expect, typically they'll start making changes, and those changes will either can benefit the company or could tear it apart. And in some cases, as a last-ditch resort, sometimes what they opt for is simply to, completely reorganize, kind of strip out valuable assets and try to, kind of salvage whatever they can of their investment and be done with it.
Yeah, interesting.
And in that sense, private equity has actually kind of, gotten a bad rap over the years because of those kinds of features. There are some types of private equity, and most private equity is not this way, but there are some types of private equity that simply go in and are focused on that kind of asset stripping from the get-go. And those are the kinds that, most companies that want to, continue growing don't really want to deal with.
Yeah, exactly. Like you said, it does have kind of a negative stereotype in some interests. Is that this is great, we have all this money, but their purpose is to squeeze every penny out of it.
Yeah, and they don't really care about your employees or your brand or anything else. They have very particular objectives, and that's why, as a seller or an owner of a business, you really need to do due diligence on kind of who it is that you're talking to, because the PE groups all have very different personalities and very different, the individuals involved and very different strategies. And it's really important to understand kind of, what type of company you're talking to.
Mm-hmm. You mentioned VC was like $6 million. You mentioned that number earlier. It's kind of an interesting. So I'm an owner of a company and it generates $30 million a year, and I am 65 years old, and I need to get out of here. Am I a large enough entity for a group to get excited for, or do you need to be super cutting edge and exciting, or like where would that fit in the?
That would fit in private equty, not in VC, typically, because if you're not doing something whiz bangy and getting lots of market share, then that's not the market for VCs if you don't have those things. But you've absolutely, for a mid-market private equity fund, that's a sweet spot. I mean, that exact, like, if you're at 2 million of EBITDA on up, and in the 10 to several $100 million of revenue, that's exactly where these guys are looking right now.
Okay, interesting. And you've added a new word to the Storytellers, whiz-bangy.
Yes.
So I'm going to quote you on that. We'll use it again in the future.
Please.
I like it.
Trademark.
Yeah, exactly. So future trends, right? That's something that we like to talk a little bit about. So we talked kind of what is a VC and a PE, what type of businesses they're looking for, what type of technologies. Where do you see things happening 2 years, 5 years down the road if we were sitting here talking again?
So I think, again, I think there's going to be just a lot more integration along the supply chain. And companies like Amazon, again, are kind of an example of that. I think that these new technologies are going to be further developed and implemented. I think there are probably entire technologies we aren't even aware of yet that are going to be popping up, that are going to be doing some incredible things too. But I think it's all going to be about lowering costs and making the entire life cycle of transportation more and more efficient. I think on the flip side, I think what customers are also demanding is better customer service, because sometimes that gets lost in the shuffle too. I mean, in terms of like making things so efficient, but you're pulling your hair out trying to get a response to something, or if something goes wrong, people play the blame game, et cetera. So I think customer service is going to be a really important thing, and that's a tough nut to crack. It's not just about having callers who come do surveys and things like that. I mean, it gets to a lot more complexity.
Yeah. Well, the changing buying habits and expectations of consumers nowadays with the Amazon effect or whatever. 2-day free shipping was, oh my gosh, amazing 3 years ago, and now that's expected.
Well, exactly. So, for example, I'm a co-founder of a company called DropSpot, and we're originally we were a non-asset-based solution for consumer package delivery. So instead of having packages delivered to your front porch where they get stolen, or if you're in an apartment building, it kind of gets into this mess of a mailroom, we would have you could actually ship it to a local place that you normally visit, like a cafe or a liquor store, dry cleaner, and it was all tech driven. So you can download these things on your phone. The problem was trying to get people to pay for that, because again, it was exactly what you mentioned, the whole free model. So we ended up becoming a strategic partner with an actual physical locker company. We've integrated with them, and we've become kind of the front end for that company, and that's kind of been our sort of where that company's evolved, because we couldn't get people to pay for it.
Yeah, that's interesting, because you're right. People, things get stolen or whatever, and to have a lockbox system.
Right.
I've heard of that in the industry.
But part of it is returns are so easy now, or if you complain to somebody that I never got it, they'll just send you another one. It's like, why pay $1 to get your package shipped to somewhere secure?
Yeah, returns, that's a whole nother animal. We had a show on that, and oh my gosh, that's a little bit crazy. So just in maybe 15, 20 seconds here, what keeps you up at night as far as related to what's going on with all this money coming into the industry?
So for me, I mean, it's effectively competing with some of the companies that I'm actually looking to acquire as well. And I've gone into bid situations where there've been 10 other bidders for the same company. So from my perspective, those guys are competition, because I also am I'm a strategic buyer of companies at the moment.
Right.
And so so that's my issue with it.
It's all about the competition.
And the prices, of course, go up as you have more buyers. So
yeah, that's great. Well, I can't thank you enough for being here today. It was real interesting. I personally learned a lot about the differences between the two types of money and how it's related to transportation and logistics. So
thank you.
Thank you for coming.
Thanks very much.
Give you an A+ as a storyteller.
Thank you.
Good to you. Awesome. And I would like to thank our audience for joining us today on the Connect and Collaborate Network, featuring supply chain and logistics, the Storytellers. Again, brought to you by Cap Logistics. Thanks.